my next slide, which is a compliance slide. And it's also secure. So this open network model is particularly useful when you're talking about migrant and remittance use cases, where it's extremely hard and expensive to reach remote locations, because in this model, local institutions can connect directly to the network and have global reach, and then from there it can route the same way an email routes through the necessary connections to the endpoint where it needs to get to fairly quickly. It's essentially a common and shared network that everybody can connect to. So one example of this is a pilot that we're doing with local savings and microcredit institutions, where we're helping them actually set up their own transfer network. So imagine in your countries if the microfinance organizations and the farmers co-ops could then start having a system that they can use internally to handle domestic low-cost transfers. And that's what we're aiming to do with that. So what about KYC, compliance, et cetera? These systems actually all do work with KYC and can actually make it faster and more efficient because the data structures are more readily available. And in these settings, KYC and that data can be shared between partner banks. You could also use an identity broker, or you could use public or authorized customer data. So for other compliance requirements, it's also possible to set up what I refer to as permission rings to comply with local law. And what that means is you can set it up so that you can have transaction volume, so that people can only transact up to a certain amount until they need to KYC for the next allowed amount. You can also decide who can transact with whom and what certain funds can be used for. And again, the case is with government subsidies, you can earmark subsidies for just milk or fertilizer or whatever the case may be. So what's stopping the world from taking advantage of these new technologies? And it comes down to roadblocks. And actually, these map very closely to what Barbara just laid out, regulatory. When technology is moving faster than the law, it is very uncertain where we slot into these systems. So what you see is a lot of people kind of waiting in the wings until we can figure out what the regulatory environment is. There's also a lack of technical resources at a lot of the companies that are trying to integrate. Most people don't have extra software developers sitting around to research the field of options, which takes me to the next point. It's a noisy space. So it's actually quite hard to sort out the fact from the fiction. There's also organizational inertia, and then the newness network effect. As I mentioned before, these open networks that actually work in a secure manner for money have only been around since 2009, so people are nervous about getting started. So, because I'm an optimist, I want to end on a high note and not on the roadblocks. So I'm going to give you a sense of the kind of impact these open networks could have, and I want to quickly show you some use cases that people have approached us asking for help for. And the first one is, people want to know if this can be used to enable families to affordably pay for prepaid solar an hour at a time so that their children can finish their homework. The difference is right now is that these prepaid solar companies can only afford to take in payment on a weekly basis because existing mobile money payment structures make it hard for them to break even when the transaction amounts are smaller. The next one is thinking of ways to help a health organization send 20 cents in bus fare to pregnant mothers so they can come in for a clinic visit and have healthier babies. It is actually hard to send 20 cents today without spending nearly 20 cents to get that money there. And then the last one is a pilot project that we're working on in South Africa. We're helping a nonprofit create mobile savings accounts for girls so that they can save 10 cents even in cash or in airtime, because that is the most ubiquitous currency for those girls. And for the topic today, these systems could also be used in refugee camps so that you can tag what amount of money goes to each person for food or clothing or other goods. So these services that I talked about, they actually can be built today locally without using any of these technologies, but it's at actually very high cost and with limited reach. You can have 100 of these spending hundreds of thousands of dollars for every deployment, but they can't connect to each other. The trick is having the infrastructure to do this in every country in the world at the same time. And that's what these networks and things like Stellar accomplish. These technologies make global micro-transactions instant and affordable, and they're finally here, so the question remains is where do we go apply them? So if you want to learn more about these open networks or learn how to reduce the cost of transactions in your region with these technologies, feel free to reach out. I'm happy to answer any questions for you about the latest technological changes that are happening there, and I will be as honest as I can be about what would work and would not work in those settings. Thank you.
That's remarkable, right? Something that costs $150 million, bringing it down to 20 cents. I'll sleep well tonight. Let me now invite Mr. Sudhir Kumar Shetty to talk directly about how he is actually providing remittances at a low cost. And in fact, his company, he's the president of UAE Exchange, that is the largest company with a retail presence in 31 countries. Sudhir.
Yeah, I think before I get into the slide, this morning we heard that migrants becoming entrepreneurs. My boss, Dr. B.R. Shetty, who migrated to UAE 42 years ago, worked for 2 years and then started the first ever comprehensive health care under one roof. And then the money transfer company today employs more than 35,000 people, including the local Emiratis. So this is what migration has done to countries, which we, in the morning we are discussing whether migration is a boon or bane. And of course, you know, in terms of the reduction of remittance cost, I have a region where the outbound remittance cost is almost 2%. The Gulf region, the GCC countries, the entire GCC country consists of UAE, Qatar, Oman, Bahrain, Kuwait and Saudi Arabia. The outbound remittance cost is hovering around 2%. Now how this was possible, I'll run through the slides. Of course, the slide says 230 million, but 247, I think maybe quarter billion almost. Remitting $435 billion of remittances to the developing region, 2014 figures. Currently, the global cost is around 7.68%, and G20 countries have a program of 5x5 to reduce the cost to 5% in 5 years. And the remittance to South Asia is among the lowest, which you will see probably in the next slide, which is around 5%, whereas the sub-Saharan Africa is 11.6%, which is the highest. It is a published figure from World Bank that almost $2.3 billion of super tax on the remittances of Africa. And I think around $20 billion will be in the hands of poor people if we are able to achieve that 5% and going forward to 3%. How we were able to reduce the cost to around 2% outbound GCC is because of the investment into technology. Now, when I say investment into technology, technology has helped us in scaling up the operations. We are now operating in 31 countries, so the economies of scale. And then we also convinced our channel partners, mainly the banks worldwide, to adopt technology so that we could eliminate multiple service providers in the chain. For example, we started educating the migrant workers the importance of opening a bank account in their home countries. This enabled us to push the transaction directly into the bank account of these migrant workers. What was the other option available? Going through instant cash products where you have a send agent, you have a receive agent, and you have a service provider. So we could pass on the cost of remittance directly to the consumer because of the connections or the correspondent relationship that we entered into with the banks in many of the receive countries. Now, apart from the direct cost involved in the transaction fee, we need to look at the cost involved for the sender to come to a location to send money, the cost involved for the receiver to go to a particular location to receive money. All these things add up to the cost. So I think the convenience factor need to be looked at. Now, the correspondent bank relationship has really helped us to serve the customer in the last mile. Probably because of the banking correspondent facility that the banks have, they expand the network to the last mile. We know from our records that people migrate from the villages rather than from the cities. So it is important that we have the network which can reach out to the last mile so that the customers do not spend some enormous money to reach to the place where the remittance is being distributed. Now, the journey of EU exchange, we as a foreign exchange company concentrated totally on money remittance right throughout. This is the 35th year of our operation, which started in 1980. As early as 1993, we got into SWIFT. Now, why SWIFT? That enabled us to get into the banking network globally and with limited cost. That helped us really to put the money across to the customer's account within a day. Now, why the timing was, the time taken to put the money across was important, because the informal channel thrived only on two reasons. One, they were faster. Two, they were cheaper. So we wanted to beat this informal channel by providing faster service at an affordable cost. This led us to have in-house IT development team who could see where the business was going, and we started rolling out products, embarking upon or embracing technology as it emerged, which resulted in offering products which were technologically highly advanced. We got into products like instant cash product as a in-between a medium, because opening the bank account for the migrant workers in the home countries is a long drawn process, but we did it successfully so far. Now, a country like India, we have almost 80% of the transactions going to the bank accounts. Now, this is the case in most of the South Asian countries, Southeast Asia, South Asian countries. Bangladesh, Pakistan, Sri Lanka, Nepal, Philippines, Indonesia, all these countries were very low on bankable customers. Now, in the last 30 years, we have seen the number of migrant workers who have opened accounts, and this has enabled us to reduce the cost considerably. Now, we just launched a product called Flash Remit in 2010, which is a host-to-host connectivity with the bank. Now, we are directly pushing the transaction into the customer's bank account wherever it is. However remote area the customer might have a bank account, we are able to push the transaction instantaneously 24/7. Even on a Sunday, the customer's account gets credited because there is no manual intervention. Our system directly pushes the transaction into the customer's account regardless where the customer comes from. Now, an SMS alert is also being generated to the beneficiary as well as to the remitter instantaneously, so that they need not even spend money on a phone call, whether the money has been reached or money has been collected. So this has really helped us in bringing down the cost considerably. Now, in addition to that, the convenience part, we provided multiple touch points for the remitter. Instead of coming to a brick and mortar store, he can use standalone kiosk. We have online money remittance called Money to Anywhere. And going forward, of course, we have the mobile apps in some countries, but it is not widely used. But going forward, of course, the digital mode that Barbara was talking about, we have two products launched with MasterCard. One is the workers' salary payment. In UAE, it is called as wage protection system, where the workers were earlier being abused and they were not given proper salary on time and not conformity with the contract that employers used to sign. But this got eliminated by pushing the salaries every month onto a card with the MasterCard platform, where the customer can use that card in merchant locations or can use it in ATMs. Now, of course, our quest for reducing the remittance fee continues, but there are challenges. One, all the money transfer companies need to go through settlement banks, especially in the US. Now, regardless where we are remitting the money, now last year alone, UAE exchange has remitted $24.3 billion of remittances. Now, 90% of these remittances get settled out of New York. Now, the settlement banks are shying away from money transfer companies because of KYC or AML formalities, whether these companies are going through properly or not. This is the apprehension that the settlement banks have. But the KYC and AML, because of the technology that we use, it is robust. It is at par with what the banks follow anywhere across the globe, because we operate in 31 countries under different regulatory regime, and we take care that everything is in place. Now, if the money transfer companies do not have a settlement bank in place, these customers are not going to go to the bank to do a transaction. They will invariably turn back to the informal channel, because the banks are not available beyond 3 o'clock in the afternoon in many countries. The banks are not available on weekends for these low-paid workers to come and do a transaction, whereas MTOs such as ours, we open 7 days a week, and we open from 8 a.m. to 11 p.m. non-stop. This is where the customers could walk in, do a transaction as and when they are free to do, and at a much affordable price than what they would probably end up paying to the banks. The other handicap that we face is there are service providers who have signed up exclusive agreements with many of the MTOs in countries, especially in Africa. That's why the Africa region, the cost of remittance is very high. One, the number of people having bank accounts. Two, the exclusive arrangements that have been signed by some of the service providers. Thirdly, there are countries who are looking at remittance tax. India is planning to introduce service tax. We have taken up with the government of India very seriously that service tax will definitely drive the customers away to the informal channel and not to persuade with the service tax. I think the government is giving a very active consideration to the suggestion that we have made. I think with this, I'll stop for the time being before Dilip shows me the 0 minute, and I am very happy to answer any of your questions. Thank you.
Thank you, Sudhirji. In fact, as we speak, I understand that Maldives would be one of the first countries to introduce a service tax of 3% on outward remittances. So this is a very serious threat, and it ought to be addressed early on. So what I would do in the next 5 minutes that we have is summarize a couple of things, if I can use the PowerPoint, of putting the whole issues in context. We know that we are addressing this issue from the financing for development point of view, and in particular we are looking at the goal that the Sustainable Development Goals have of reducing remittance costs to 3%, and in fact you can see the last point, that 10.C, by 2030 reduce to less than 3% the transaction cost of migrant remittances and eliminate remittance corridors with costs higher than 5%. That is explicitly, that's actually taken from the SDG document. So that's what we are after. And then the Financing for Development document from Addis Ababa Action Agenda elaborates on that, basically on the same point, and including many of the issues that we heard now. So how does it all fit in? You know, I see the Global Remittances Agenda, which you can also rename it as an agenda to harness diaspora resources, including remittances and other resources, in sort of 4 major components. And we touched on all of them. First is monitoring, analysis, projection. If we didn't know that remittances are 3 times the size of official aid, we wouldn't be here talking in the World Bank. So that's the sort of importance of knowing the market size. If we didn't know that the market size was 680 billion plus, then there wouldn't be so many players, you know, investing a lot of money. So that's the important part. The second part is the retail payment system, where you get into the technological aspects, which we talked about both with MasterCard as well with Stellar. There are also a lot of experimentation going on, including mobile phones and all that. And that's where also you get into the issue of anti-money laundering regulation and de-risking by commercial banks, which has become something that is amazing. You know, what is happening on security and, you know, this anti-immigrant, anti-travel, anti-everything, everybody sort of movement. Same thing is happening in the financial sphere, exactly opposite to the sort of declarations we have on financial inclusion for all. There is a contrarian trend from the regulation point of view, which is saying pull back, don't serve the poor. So there is that issue that comes under the second agenda. The third agenda, which is completely underexplored and which is where MasterCard, we heard from Barbara a bit, some additional move for the development, is financial access for households and SMEs, small and medium enterprises, that could be fostered through remittance channels. And there is quite a bit of work still to be done there. I just gave a talk at TEDx Gateway in Mumbai on creating a people's bank. We can talk about that another time. The final one is where you look at leveraging remittances and diaspora resources for capital market access for countries and big banks and companies. We are talking about billions of dollars of bond financing there. And that is where the issue of how remittances contribute to sovereign credit rating, how bonds backed by remittances could be used as collateral to reduce borrowing cost and lengthen maturity, and also how diaspora savings could be mobilized in billions of dollars through diaspora bonds, which is what we heard from Mr. Ram Logan. So let me then quickly give you an order of magnitude of what we are talking about. All these things add up to about $100 billion idea. Diaspora savings that could be mobilized through diaspora bonds for developing countries. If you mobilize only 1/10 of the diaspora savings, you are talking about $50 billion per year. If you reduce remittance cost, you are talking about $20 billion per year. If you reduce recruitment fees paid by low-skilled migrants, you are talking about another $20 billion. If you are talking about mobilizing diaspora philanthropy, that's $10 billion. And happy to say, all these numbers are underestimates. So there you go. I gave you a $100 billion idea. Let me throw in a little more. Here is a little more. Bonds backed by remittances. It's a bit like water is flowing. You set a turbine, you generate electricity, water keeps flowing. That's the same mechanism that is used when money is flowing from a foreign bank to a local bank. You set up a special purpose vehicle, issue the bond is issued offshore. There is no risk of currency transfers. There is no risk of currency devaluation. There is no risk of sovereign appropriation. These are the three major components of sovereign risk. They bring down sovereign risk significantly. So the rating for a country like Suriname or Bangladesh should go from B- or double B- to something like triple B, meaning above investment grade. And if you have that, interest costs go down, interest costs can go down significantly. This is not just a theoretical point. More than $20 billion have been raised by Brazil, Turkey, Mexico. I can name about 10 other countries. And in one particular case, Banco do Brasil raised about $1 billion during one of its worst crises, 2002, and in Brazil, I mean, when the sovereign spreads were 18% on borrowing costs were 18%. And Banco do Brasil raised bond financing at an interest rate of 9 to 11% on those bonds. A saving of 10% on average, 10 percentage points. So we're talking about 1,000 basis points by using future remittances from Japan coming to Brazil as collateral. This is a concrete example. It has been written about, and you can find it in the public discourse.